Hey everybody, this video is about what's in and what's out of GDP. But more importantly, this video is about you understanding GDP. Because if you understand GDP, it is easy to determine what transactions are in and what transactions are out. Now, of course, we should start with the definition of GDP. So, what is GDP, or gross domestic product? It is the total value of goods and services produced within a country within a specified time period. Now, you internalizing this definition will take you a long way to understanding what transactions are in or out of GDP. Now, when I'm asked whether or not a transaction is in or out, I think of the following visual. And I've got this timeline right here and this little blob I'm calling a geographic region. Now, let's talk about the timeline first. Of course, it says previous year, current year, or following year. And we need to make a little note. When you hear the word current in economics, it doesn't always mean present. It just means the current year you're looking at. Like right now, the present year is 2020. The current year that could be the year we're calculating GDP for, that could, of course, be 2019 or any other year, okay? So current year just means the current year you are looking at for calculating GDP. Now here's the key, guys. Production must happen in that current year, and it must happen in that geographic region. So let me put that here. The production, okay, must happen inside of that current year, and it must happen inside the geographic region. We don't care who owned the factors of production that produced the good. We don't care actually who produced the good or service. GDP is a where measurement. It cares where and it cares when, and that's it. Now, let's go to the next thing. The next thing is the government must see the transaction, okay? See, there's some transactions the government never sees. There's some value that is produced the government never sees. And if the government doesn't know that value is produced, it can't be in GDP. Now, there's three major examples. One is called non-market production. Non-market production is volunteering and household production, okay? Volunteering, that's self-explanatory. Household production is when you mow your own lawn, do your own dishes, vacuum your own house, okay? You're producing value, but hey, it's non-market. The government's never going to see that value being produced, so of course it's not going to be in GDP. Then there's informal markets. Informal markets is where the good or service is a legal good, but it's just not being reported. Say you mow your neighbor's lawn and you just get paid in cash and nobody reports it. Government doesn't see it, it's not going to be in there. You go babysit. Again, if nobody reports it, it's not going to be in there. Any under-the-table payment, okay, for a transaction, not being reported on either side of the transaction, government doesn't know about it, it's not going in GDP. And then, of course, black markets, right? Black markets, the good or service is illegal, and of course, that stuff is going to be hidden from the government. So the government does not include, again, non-market activity, informal market activity, or black market activity. Now, I want to very quickly talk about the approaches to calculating GDP, because sometimes they can confuse and sometimes they can give clarity to what's in and what's out, okay? Again, these approaches are approaches to calculating GDP, and that's what GDP is. Now let's talk about the expenditure approach first, okay? The expenditure approach looks at consumption spending, investment spending, government purchases, which is government spending, and then net exports, which is exports minus imports. Exports is when the rest of the world spends money on our stuff. Imports is when we spend money on the rest of the world stuff. So again, this right here, the C plus I plus GP plus NX, guys, that is the expenditure approach to calculating GDP. But here's the interesting thing, guys. GDP is all about what was produced. And at first glance, the expenditure approach is all about what was bought. Okay, it's looking at the spending. Now, these two things are not always equal. When might they not be equal? Well, bought can be more than produced, okay? Now, how could that be? Well, that could be because, hey, we carry inventories into a current year. There's already some stuff on the shelves when we go into a current year. So we can actually buy more than what was produced during the current year. And, of course, produced could be more than bought. That's pretty easy to understand, right? That'd be a situation inventories would go up. But here's the big point. It's basically the point I've already been making here is when these could be different is when inventories have changed. So inside of this I, we have inventory adjustments being made. So we make inventory adjustments to what was spent, that's this part, so that we can get what was produced. Again, it doesn't really matter if you buy something here, okay? It matters where the good was, when the good was produced. Doesn't matter if we buy stuff here, all right? It matters where it was produced. Was it produced in the geographic area? Was it produced in the current year? It's all about production that we care about. Again, the expenditure approach is just approach to capturing the value that was produced. Now, the income approach, what that does for us is it reminds us that if it's somebody's job to do it, it's going to be in GDP. Let me say that again. If it's somebody's job to do it, it's going to be in GDP. Guys, every single job out there is focused on producing value. That's what jobs are. Jobs are work, and work to an economist is you producing value for others. That's the whole point of work. And so, of course, you are producing value. So if you're ever like, I'm not sure if it's in or out, hey, if somebody's doing it as their job, it's in GDP. Value-added approach. That helps us a little bit here when it comes to intermediate goods, okay? If we capture the value of intermediate goods and the value of final goods and we add those together, we're going to get a number that is greater than the total value produced within a country. We don't want to double count value. So if we count the value of the final goods and services, here's the thing. We're going to capture the value of all the intermediate goods or services. So generally speaking, if you get a question that's got an intermediate good in there, truly the value of that production, yes, it's in GDP, but we're going to say that transaction of buying the intermediate good is not in there, because if we include that transaction in GDP, we're going to end up overstating what GDP is, okay? Again, we just want the total value produced. If we count the price of the final goods and service, which we do, we don't want to count the prices of all the intermediate goods, because that will make us double count the value of the intermediate goods. Okay, so that's income approach, value added, and expenditure approach. One last thing I want to do as we close this video out, talk about a couple that kind of mess students up. Commission paid to a stockbroker. Of course, the value of a stock transferred between the buyer and the seller, not in GDP, because there's no good or service being produced. It's just a transfer of ownership. And if all we're doing is transferring ownership, it doesn't go into GDP. We want the production of goods and services, the production of value. But if somebody facilitates that exchange, hey, that's their job to facilitate the exchange. The commission paid for facilitating that exchange, hey, that's for sure going into GDP. Again, it was somebody's job to facilitate that exchange. Next, rental income, okay? Let's say it's you rent an apartment, but the apartment was built several years ago. Is the rent paid for the apartment going in? Absolutely, okay? Another question you can ask yourself on what's in and what's out is, was a business organized to do this thing? And yes, a business is organized to rent out apartments. And so guess what? That rental income for sure goes in. If you go rent a car somewhere, okay, and that car was produced several years ago, but you go somewhere and rent a car from Hertz or Avis, which are companies that rent cars, guys, that business, those businesses were formed to do this type of activity, to rent this stuff out, to provide this rental service to us. So rental income for sure goes in too, because a business was organized to provide this service to people, that you could go rent these things, okay? It's not that we're counting the value of the production of the good like the car. We're not. We're just counting the rental income, the renting of the apartment, okay? That's what's key there. Now, as we close this out, I want to give you one final little example question and see if you can get it. Let's just say that Lisa drives to Fred's used car lot dealership and sells her car for $5,000 to Fred's used car lot dealership. And the next day, Mary goes on to Fred's used car lot dealership and buys that car for $7,000. So again, let's keep it straight. Lisa sells her car, a used car, of course, right? Lisa didn't make it. So Lisa sells it for $5,000 to Fred. The next day, Fred sells that to Mary. Now, Fred is running a business for $7,000, so sells that car to Mary for $7,000. Is any part of that transaction going into GDP? And the answer is absolutely. How much? $2,000. Guys, we're not going to double count the value of the car. That car is a used car. That's just a transfer of ownership when it comes to the value of the car. But Fred, he's providing a service. He's a market maker. He's bringing together suppliers and demanders. And the fact that he made $2,000 on that transaction, remember, he's doing a job. He is a business. Absolutely, that $2,000 is going into GDP. Again, Lisa sold the car for $5,000. Mary bought it for $7,000. That 2,000 differential is going into GDP because that's the value that Fred produced by being a market maker, bringing together Lisa and Mary. Anyhow, guys, that's pretty much a complete video on what's in and what's out, okay? If you've ever got a question, I think your question is going to be answered in this video. Hope you have a great day. We'll see you in the next one.